The problem from this video can be downloaded at accountingworkbook.com. If you go to the website, click the PDF link and you can download a copy of this and all of my problems for yourself. Now, if you check the website and you click on videos, you'll see there are more videos than those I've listed publicly on YouTube. You can see that there's every problem covered in the workbook has either a public video or a members only video. If you'd like access to the members only video, just click the join button beneath the video player on YouTube. All right, let's jump into the problem. Let's take a look at problem 3.3a. This, ladies and gentlemen, is a terrific problem. It has us doing adjusting journal entries. We're going to prepare an adjusted trial balance, and we're going to do financial statements. So it's so comprehensive. You're going to get a lot of good information in this. It'll be a series of videos, but what a great problem. Here we go. Below is the June 30th, 2024 unadjusted trial balance of NetLock Security, a firm that offers hacking prevention services to large companies. So anyway, there's their trial balance. Okay, fair enough. I guess things that kind of jump out at me, I go, okay, well, there's supplies, so probably we'll do an adjusting journal entry for supplies. There's prepaid insurance. I see they have a long-term asset, so I'm going to have to do depreciation entries and all sorts of other things. You know, I sort of scan down the list. I see unearned security revenue. Well, where there's unearned revenue, there are adjustments to be done. It says the company's fiscal year end is June 30th, and the following items require adjustment. And there's a big long list, A, B, C, D, E, F, G. So we're going to have, 7 items requiring adjustment. And part A says, give us some adjusting journal entries. Now, if you haven't done so, and I will have uploaded this, a video walkthrough of problem 3.1a, just explaining what adjustments are and how to do them. And at the end of the video, I prepared this little cheat sheet that says in our class, in my course, there's 5 kind of introductory adjustments. There's adjustments for prepaid expenses, depreciation, accrued expenses, accrued revenues, and unearned revenues. And this problem has us doing just adjusting journal entries. So we're not going to do any of these like setup entries. We're going to be focused in on this column, and let's see how it goes. So let's look at the first one, A. A says, account of supplies reveals that $300 of supplies are on hand on June the 30th. Okay, so again, all of our adjustments are going to be dated June 30th. So this is part A. Let's just do this. June 30th, and we're doing the journal entry for this one. So we have $300 worth of supplies on hand. Well, that's fine, but remember what we're interested in. These supplies are prepaid, so we're looking at the top column there. We're interested in how many dollars worth of supplies we used up, or how many dollars we need to expense. Well, here's where we need to look. We need to go up here and have a look at the supplies. So according to my accounting records, I have $5,000 worth of supplies. I go out and I physically count the supplies, and I have $300 worth of supplies. There's a problem here, right? My accounting records do not match reality. Reality says $300 of supplies. That's how many you've got in your supply cabinet. My books say $5,000. I got to fix my books. I got to adjust my books. So by how much? Well, again, my books say 5,000. Reality, my count, says 300. 5,000 minus 300 means the difference here is $4,700. I have to reduce my supplies asset by $4,700. So I credit supplies $4,700 because they got to go down by $4,700 from 5,000 to 300. The debit here is to supplies expense to record the fact that I used up some of my supplies. And you can see up here the journal entry for prepaids. Debit some sort of expense, credit some sort of prepaid assets. In this case, it's supplies expense and supplies. We got another prepaid coming, so I'll just leave this highlighted. The $28,000 insurance policy was purchased on March 1st, 2024. Okay, so if I scroll up here, I'm expecting to see, and I do see, under prepaid insurance, $28,000. So they're saying, hey, this was purchased, and you know what? What's not being said is this was a 12-month insurance policy, a 1-year insurance policy. Um, Now, if it doesn't say that, you got to ask your prof because it could be a 2-year, 3-year, but the assumption would be, unless it tells you otherwise, assume you buy insurance a year at a time. That's a good assumption. Um, okay, so it's a 1-year insurance policy. We bought it on March 1st, 2024. Today is June 30th, 2024. So we got to say, okay, do I have $28,000 worth of insurance? The answer is no, right? I've used some up. Some of that insurance has expired. Between March and June, I've been using the insurance. So March, April, May, June. That's 4 months. So the math here is 28,000 times 4/12. A mistake some students make here, it's not really a mistake, but something some students will do here is they'll buy the insurance policy. So they'll go debit, prepaid insurance, 28,000, credit, cash, or AP, 28,000. That's fine, except for we've already done it. How do I know we've done it? Because it's already there in the books. So some other accountant has done this already. We're getting to this question at year end. So somebody else has done the journal entry to buy the insurance. We've got to record the adjustment. So we're not doing the setup, debit, prepaid insurance, credit, cash, or AP. No, no, no. We're doing the adjustment. We're focused in on that right-hand column. So we want to know how much insurance did we use up, just like here we wanted to know how many dollars worth of supplies we used up. So how many dollars worth of insurance did we use up? I can't do this math in my head. I think it's going to give me an awkward number. I was hoping for nice even numbers. 28,000 times 4 divided by 12, 9,333. $9,333 of insurance got used up. So June 30th, and this was journal entry A. Here's journal entry B. A debit, insurance, expense, credit, prepaid insurance for the insurance we used up, $93.33. I always say used up. Another way of saying that is the amount of insurance that has expired, right? How much insurance has expired here? Okay, that's B. Let's clean this up. Move on to C. The computers were purchased years ago for $214,000. So a long time ago, we purchased these computers for $214,000. At the time of the purchase, the estimated life of the computers was 10 years with no estimated residual value. Okay, this is actually easier than we've done in previous problems. In previous problems, I've said, oh, they purchased these on June 30th, and you got to figure out, oh, how many months have gone, or on, let's say, April 3rd, and you got to figure out how many months between April and June, and do 2/12 or whatever the number is. Here, we purchased them years ago for $214,000. And at that time, the estimated life is 10. So here's what we do. We say, okay, well, if we purchased them years ago, we got to depreciate this for a full year. We've owned these for 1 full year. So I have these $214,000 worth of computers. I don't even need to look at the AD on those computers. Okay, obviously, they've depreciated a little bit because I've owned them for a little while. That doesn't matter to my calculation. I divide here by 10 years, and I say the rate is $21,400 a year. So obviously, if there was $46,000 in depreciation already, I've owned them for a couple of years, which makes sense. I've got more than 2 years of depreciation. I just have to put 1 more year of depreciation on these computers. So the journal entry on June 30th is the journal entry that we always have for depreciation. So we're done with prepaids now. We're doing a depreciation entry, and again, we're not doing the setup, we're doing the year-end entry. Debit depreciation expense, credit accumulated depreciation on our computers. $21,400. Okay, that's C. Let's move on to D. D, the note payable was issued in February 1st, 2024 and accrues interest at a 10% annual rate. The note is expected to be repaid in late 2024. Who cares when the note's expected to be repaid? That doesn't matter. Expectations don't matter in financial accounting. It is what happened. So we lent somebody, or we borrowed rather, $30,000. There it is. There's a note payable for $30,000. We borrowed $30,000, and it accrues interest at a rate of 10% annually. So let's do some math here. D, $30,000 times 10% is $3,000 per year. Okay, so $3,000 a year is our interest cost. Now, we hadn't borrowed the money for a full year. We borrowed it on February 1st, 2024. So it's June 30th today, so count February. February, March, April, May, June. Why did I count February? Because it was February 1st, right? If it was February 28th, I wouldn't count February. But February, March, April, May, June. 5 months. So 5 months of interest means it's 5/12ths of a year. 3,000 times 5/12ths. It's going to be, again, an uneven, awkward number. Clear, 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 clear. Oh, this thing works inconsistently. 3,000 times 5 divided by 12. If you ever think my writing is messy, blame the computer screen. Don't blame me. I have gorgeous writing in real life. Just gorgeous. I'm lying. Okay, the journal entry here. June 30th. It's a journal entry for interest, and it's an interest cost. This is an accrued expense, right? It's a cost that is built up over time, but we haven't, let me get this in red, that we haven't paid yet, right? We haven't paid them back. So we're going to debit some sort of expense, credit some sort of payable, and to hopefully nobody's surprise, it's debit interest expense, credit interest payable. Let's do it. Debit interest expense, credit interest payable, and the amount is $12.50. Okay, on to the next. E says, on May 1st, 2024, the company entered into a 3-month contract to provide security for a major corporation. The corporation paid $15,000 for their 3-month contract on May 1st. So we're getting paid in advance. If May 1st I enter into the contract, I'm going to do work for 3 months, and they paid $15,000 on May 1st. It means they paid before I did any work. This is an unearned revenue. I'm expecting to see unearned revenues of $15,000, and you know what? I do. There it is, $15,000 of unearned revenue. So back when that happened, the accountant did a wonderful job. They went debit cash, credit unearned, security revenue. And that amount was correctly recorded as unearned revenue. On June 30th, NetLock had fulfilled the first 2 months of the contract. So what this is saying is, look, we said this was all unearned revenue. This is a liability. We owe them service. We owe them security work. Well, guess what? We've delivered 2/3 of what we owed them, right? It's a 3-month contract. May and June, we've fulfilled the first 2 months of that contract. So we've done 2/3 of the work. We've earned 2/3 of the revenue. So here we go. E, 2/3 of 15,000 has been earned. 2/3 of 15,000 is 10,000. We've earned $10,000 in security revenue. So the journal entry for an unearned revenue, looking at our cheat sheet here, it's the bottom. Again, sometime in the past, we went debit cash, credit unearned security revenue. Now we debit unearned security revenue, and we credit security revenue. Just going to make sure we have an account called security revenue. We do. So let's do it. Debit unearned security revenue, credit security revenue. And the amount, of course, $10,000. Moving on to F. Just 2 more here. F says, the company had 3 employees who were owed for 2 days of salaries each, as implied, at year end. Each employee earns $250 a day. This is like a word puzzle. Okay, so this is an accrued expense, by the way. Salaries, unpaid salaries is an accrued expense. So what's happening here? We have 3 people. They're all owed $250 a day, so that's $750 a day, and we owe for 2 days, so we owe $1,500. That was a mouthful, right? The company had 3 employees who were owed for 2 days' salaries. Each employee makes $250 a day. So I've kind of reconfigured that and said, okay, 3 people, they all make $250 a day, so that's $750 a day in salaries that I'm going to owe. I owe 2 days, 750 times 2, 1,500. Okay, so 1,500 of unpaid salaries. The journal entry here is pretty simple. Debit, salaries expense, credit, salaries payable, $1,500. There we go. There's F. On to G. G says, clean this up a bit. G says, on June 1st, 2024, the company entered into an agreement to provide service for a new client at a rate of $4,000 a month. At the end of June, the client had received their first month of service but had not yet been billed. Okay, so we've done work for which we haven't been paid and we haven't even billed it yet. This is a great example of an accrued revenue. It's revenue building up because I'm doing work, but for which I haven't been paid. I'm going to debit some sort of receivable, probably accounts receivable. There could be some sort of accrued revenue receivable depending on the company's chart of accounts, but I think we can fairly call this accounts receivable and just credit our normal revenues here. We're doing work. Let's see, are there any other receivables? No, so I would say accounts receivable and just plain old security revenue are the 2 accounts here that make the most sense. And it's a month. We don't have any math to do here. It's $4,000 a month and we've earned a month. So G, June 30th. Debit, accounts receivable, $4,000. Credit, security revenue. Security rev, $4,000. Okay, we have done all of the journal entries, the adjusting journal entries. Our next step is going to be to fill this in and to prepare an adjusted trial balance. So we'll fill in these columns and we'll do that in our next video. Stay tuned.